2023 is likely to remain a challenging year for real estate because home prices aren't crashing, inventory is not flooding to the market, and interest rates aren't dropping nearly as much as we thought they would due to job growth and inflation remaining super high. Even though we're still seeing inflation cool, it's not cooling at the pace that many economists out there are expecting. While the headline CPI number dropped year over year to 6.4%, economists were expecting 6.2%. And it's a similar story for the core CPI, where we saw a number report 5.6% year over year, where economists were expecting 5.5%. And because of that surprise in numbers, we actually saw volatility in interest rates. We've seen interest rates go from 6.07% on a 30-year fixed at the time of the last CPI print to 6.54% at the latest CPI print. That said, that's nearly $154 per month on a $500,000 mortgage. But here's the best part. Interest rates haven't stopped going up. So the question is, should you buy a house now or should you wait? Are you going to regret buying a house in 2023? Well, that's what we're actually going to dive into in today's video. We're going to take a look at inflation. What is causing inflation to remain high? Is the Fed going to pause, pivot? Are they going to continue raising rates? Is the economy going to remain strong? These are things that we're going to address in today's video, along with talking about inventory, in addition to talking about where the opportunities are in this market. So not only can I educate and empower you, but I want to guide you through the home buying process. So do me a favor, if you find any value in today's video, click that thumbs up and feel free to subscribe to the channel to stay updated on everything real estate related. As we know, the US CPI moved from a peak of 9.1% last June to 6.4% last week. So what are the main factors driving that decline? Well, we have both new and used car sales declining. We have gasoline declining. We have medical care. We have apparel. We have food at home, electricity. All of those things are declining, which is bringing that inflation number down. But at the same time, we have a couple of factors that are actually pushing the inflation numbers up. And those things include things like shelter, transportation, food away from home. And I know many of you guys are on top of this because you're mentioning it in my videos. You're talking about how expensive rent still is, how expensive flights are, how expensive going out to eat is. All of these things are keeping inflation high. So the real question is, when will we actually see a decline in these numbers? When will we start to see these numbers slow? Because with the numbers slowing, we're likely to see inflation coming down. As inflation comes down, we're likely to see interest rates follow. We're likely to see the Fed back off their super hawkish stance, which should give the market some time to breathe and ultimately create less volatility in the market. And with less volatility, we're likely to see some stabilization in the housing market. Shelter inflation increased to 7.88% from 7.51% in December, which is ultimately the highest on record. At the same time, rent inflation increased to 8.56% from 8.35% in December, which is also the highest on record. So while we know shelter is a lagging indicator, and we've also seen rent growth slow to the lowest level in nearly 20 months. And at the moment, that's not reflected in these inflation numbers because of the lagging data. So as we get reports over the next couple of months, we should start to see these declines reflect in the inflation numbers, which should ultimately bring inflation down a little bit quicker than many out there expect. On top of that, we've actually seen the Case-Shiller Housing Index decrease for 4 consecutive months. Nationally, home prices increased 6.9% year over year in December. Idaho was the only state to post an annual decline in home prices. The states with the highest increases year over year were Florida, Vermont, and South Carolina. In addition, the CoreLogic House Price Index indicates that home prices will decrease on a month-over-month basis by 0.2% from December 2022 to January 2023, and increase year over year by 3% from December to December. As you can see from this chart here, in December, home prices were 6.9% higher year over year. According to CoreLogic, that was the lowest annual appreciation rate since the late summer of 2020. But here's the bad news. Last April, price appreciation was nearly 20% year over year in April. So while we are starting to see home prices pull back, decelerate in many markets, if you bought a year ago, there's still a really good chance that you have equity in your property, that your home is worth more than you paid for it. Now, as we continue to move through spring, depending on what happens to inventory, depending on what happens to interest rates, you might actually see a year over year flattening, possibly even a year-over-year decline in home price appreciation, which means that many people that bought their houses in the second quarter of 2022, if they put a small down payment, they could end up being underwater on those homes. But here's the crazy thing. It means absolutely nothing unless those people have to sell those properties for one reason or another. As long as those people continue to make their payments and don't have to sell for one reason or another, then the market continues to move on. So all of those people out there talking about people being underwater and the housing market crashing, that really means absolutely nothing. This is not 2008. 2008 was a different year because of distressed sales. People had adjustable rate mortgages adjusting to a higher level. They weren't in a position to refinance those mortgages. And with the interest rates going up and the payments going up and the homeowners having absolutely no equity in those properties, those homeowners had an opportunity. They had a choice to walk away from that property and potentially go rent something for much less money than they were paying on that mortgage. Well, this time, it's completely different. You don't have distressed sales. In fact, foreclosures are still sitting at levels lower than we were prior to the pandemic. So while there might be some people out there that are forced to sell because they lose their job, they don't have money in the bank, and they have no equity in their property, that's not going to be the majority for most people out there. Most people are sitting on super low interest rates, along with a ton of equity, which is exactly why you're not seeing a ton of inventory come to the market right now. Because for most people, it doesn't make sense to sell their home and go out and buy something else. For one, house prices are higher. Secondly, interest rates are also higher, which we're actually going to dive into more here in just a minute. So the reason we actually saw home price appreciation slow so much is because of weaker housing demand. The things that we talked about earlier, inflation, job cuts, interest rates, along with the other uncertainty in the economy, more or less put the brakes on housing. But as we saw mortgage rates decline in December, we actually saw prices react almost immediately. While prices continued to fall from November, the rate of decline was lower than seen in the summer and still adds up to only 3% cumulative drop in prices since last spring's peak. That's according to the chief economist at CoreLogic. So as you can see, interest rates are having a much bigger play on the housing market than many people out there want to admit. As we've seen interest rates decline, we've actually seen the housing market pull back. We've seen multiple offers in our market. In fact, the last buyer that I put into escrow, there were multiple offers on that property. Now, I realize this isn't happening in all markets out there, but a lot of markets are seeing a pickup in activity due to lower interest rates. And something I want to point out here, people commenting on my video saying interest rates are going to 8, 9, 10%, and also in the same sentence talking about a decline in the job market and everything crashing and the economy being in such bad shape, both aren't going to happen at the same time. Understand that. As we get good news on the economy, for example, the job market creating 516,000 jobs in January, that's positive news for the economy. Well, guess what? That's bad news for interest rates because that shows that the Fed is likely to continue their stance. They're likely to continue raising the Fed funds rate. That gives them ammunition, if you will. Good economic data is actually bad for interest rates, whereas bad economic data is actually good for rates. So you can't, in one sentence, say the economy is doing poorly, everybody's losing their jobs, we're headed into a recession, and then also say that interest rates are going up. So the question I ask you as a viewer is, where do you think the economy is headed? Do you think we're headed into a recession? Do you think we're in a recession? Or do you think we're in this great economy? Because how you answer that question should also answer the direction that you think rates are going. And the reality is, if you want to see some more inventory come to the market, if you want to see further decline in home prices, you actually need to see interest rates move higher. You need to see interest rates back up above that 7%. That's actually when we saw the biggest declines in house prices because it affected buyer demand. Because of housing affordability affecting many buyers out there, less people being able to actually go and buy these homes, homes were sitting on the market longer. Sellers were having to reduce their prices if they had to sell those homes. But like I said a minute ago, as soon as we saw interest rates come down, housing affordability picked up just a little bit, we actually saw the housing market get a little bit of strength, and because of that, demand picked up. But here's one of the major problems for the housing market at the moment. It's the number of newly listed homes coming to the market. In January, the number of newly listed homes for sale declined by 5.4% compared to the same time last year. This is a much lower rate of decline than last month's 21% decrease and November's 17.2% decrease. However, New listings remain 25% below pre-pandemic 2017 to 2019 levels. So the problem is you're not seeing a lot of new homes come to the market. So for everybody out there saying the housing market is flooded with inventory, for most markets out there, it's not. As you can see from this chart here, many levels remain well below the pre-pandemic levels, even though we've seen a year-over-year increase. Now, existing home inventory is actually up 78% compared to the same week in 2022. But here's the kicker, we're down nearly 45% from that same week in 2019. And because of that, inventory remains historically low. So we actually need inventory to increase substantially in 2023 because currently we're down about 10% in the first 6 weeks of 2023. As I mentioned earlier, real estate is all local. Actually, take a look here at a couple of different comments from viewers on my channel talking about housing inventory in their markets. The first comment comes from Evan Keaton. Inventory here in Dayton, Ohio is trash. Out of 25,000 homes in the city of Kettering, Ohio, there are currently only 30 homes available on the MLS. If any decent home becomes available, it's sold within 24 hours over the asking price. In addition, you have Coffee and Donuts up in the Northeast saying prices in the Northeast are still climbing. Inventory is non-existent. Move-up buyers are nowhere to be found. With no move-up buyers, the market for first-time home buyers is dead. So for existing construction, it's going to be difficult because, again, many sellers have locked in low interest rates, but the opportunity in the market is going to come from new construction. At the moment, there are nearly 5.5 months of homes under construction, which is well above the normal level. Now, many of these homes haven't been built because they had supply constraint issues back in 2020 and 2021, which has delayed that construction. So as those supply constraints have normalized, we're starting to see those homes, get towards the end of construction, which should mean the second part of 2023, you're going to see a lot of this inventory come to the market. Now, if you look at this chart here, only 1.4 months of inventory is actually completed with regards to new construction at the moment. That's the red line, which is more or less in line with a normal level. But it is likely that we're going to see a sharp increase in completed inventory over the course of 2022, which is likely going to have a bigger impact on house prices in those markets. So if you're considering buying a home, just make sure you're buying for the right reasons. You're likely to regret buying a house in 2023 if you have a shorter term time horizon. If you're someone only expecting to buy that house and live in it for 1 or 2 years. Why? Because home prices appreciated so much over the last couple of years. In order to get back to that long-term trend of 4.6% over a 65-year period, you actually need to see some sideways movement in houses. You actually need to see house prices decline in some of these markets. And that's what we're likely to see over the next couple of years, a housing market that just more or less moves sideways, which means that you could see a bump in the housing market here in spring, in the spring selling season when the market is the hottest. You could see housing pick up. You could see some gradual appreciation in homes. But as we move through the summer and the housing market peaks, you're likely to see some declines in the second half of 2023, especially in areas that have a lot of new construction because of those homes coming to the market and because of the seasonal slowdown in housing during that time, which could mean that whatever appreciation you see in the first half of 2023 might actually be taken away in the second half of 2023. But as long as you're buying for the right reasons, you have that longer term time horizon, then you're likely not going to regret buying a house, because not only does real estate provide stability for families, it also goes toward creating long-term generational wealth. That's why homeowners have a 44 times greater net worth than those of renters. So if you're someone looking to buy for the right reasons in 2023, you have that longer term time horizon, you have money in the bank, and you're not stretching yourself, do me a favor and check out this video here where I talk about the things you should focus on.